There are moments in history when nothing seems to be happening, and yet everything is already in motion. Markets are open, charts look stable, news cycles feel repetitive, and that's exactly when the most important shifts take place. Right now, the global financial system is sitting in one of those moments, a calm surface masking deep structural stress. Central banks continue to speak in careful language. Governments reassure the public. Analysts argue over interest rates, inflation prints, and quarterly earnings. But behind this noise, a quieter story is unfolding. Across private vaults, offshore storage facilities, and discreet bullion desks, billionaires are quietly accumulating silver, even at prices near $75 an ounce. No press releases, no social media posts, no public interviews, just quiet positioning. And historically, that silence has always meant one thing. Smart money sees a storm before the clouds appear. To understand why this matters, we need to look backward before we look forward. Before the Great Depression, elite investors moved into hard assets while the public chased stocks. Before the collapse of Bretton Woods in the 1970s, gold and silver were accumulated quietly as confidence in the dollar eroded. Before the 2008 financial crisis, institutional capital shifted away from complex paper instruments into tangible value. Long before the headlines caught up, the pattern is always the same. Public optimism peaks, private fear rises, and positioning begins. Silver, unlike most assets, has always acted as a whisper before the scream. It doesn't usually explode during the boom phase. It moves when something underneath the system breaks: liquidity, trust, or confidence. That's why silver has a strange habit of waking up before collapses, not after them. But why silver? Why not stocks, bonds, or even gold? The answer lies in silver's forgotten role. Silver is not just a metal. It is not just a commodity. It is one of the oldest forms of money humanity has ever trusted. For thousands of years, silver circulated as currency long before paper promises existed. Empires rose and fell on it. Trade routes were built around it. Wars were financed with it. And unlike gold, which was hoarded by kings and central banks, silver belonged to the people: merchants, soldiers, craftsmen. It was money that moved. That legacy still matters today. Because when modern financial systems begin to wobble, capital doesn't just look for return. It looks for survivability. Right now, survivability is under question. Global debt has reached levels never seen before in human history. Governments are borrowing not to grow, but to survive. Central banks are trapped between inflation and collapse. Raise rates too high, and the system cracks. Keep them too low, and currencies lose credibility. This is not a normal economic cycle. It is a structural one. And structural crises don't resolve quietly. Billionaires understand this. They have access to data the public never sees. And more importantly, they understand incentives. They know central banks will always choose currency debasement over systemic failure. They know political promises are made in fiat terms, not real ones, so they position accordingly. Silver becomes attractive not because it's fashionable, but because it sits outside the system. No central bank controls it. No government can print it. No algorithm can create more of it overnight. And here's the part most people miss. Silver is small. The entire global silver market is tiny compared to equities, bonds, or even gold. That means it doesn't take much institutional capital to create massive price movements. A small shift in allocation from large players can cause outsized reactions. That's why silver often moves suddenly, violently, and without warning. Another reason the accumulation is happening quietly is psychology. Silver is underestimated. Gold gets the headlines. Bitcoin gets the hype. Stocks get the attention. Silver sits in the background, ignored, dismissed, labeled boring. And that's exactly when smart money prefers to buy. Because by the time silver becomes exciting, it's already expensive in real terms. When billionaires buy at $75, they're not chasing price. They're securing exposure before the narrative changes, before shortages become visible, before paper contracts diverge from physical reality. Because silver has another unique trait. It's consumed. Unlike gold, which mostly sits in vaults, silver is used and used up in modern civilization. Solar energy, electric vehicles, military systems, medical technology, advanced electronics, all depend on silver. Once it's embedded into these systems, it rarely comes back. That means above ground silver is disappearing quietly while demand continues to rise. This creates tension. A market where supply shrinks, demand grows, and confidence in paper assets weakens does not correct gently. It snaps. And when it does, the public won't be invited early. The accumulation phase always happens in silence. No announcements, no celebration. Just positioning while everyone else is distracted. That's where we are now. The silence before the storm. In the next part, we'll break down exactly why silver historically performs before collapses, and why its movements often shock even seasoned investors. Silver does not behave like a normal asset. That single sentence explains why so many investors misunderstand it, and why those who understand it move early. In calm markets, silver looks frustrating. It underperforms stocks, lags fashionable trades, and appears directionless. Analysts dismiss it as volatile. Commentators call it unreliable. And during economic expansions, silver often feels like dead weight. But history shows something very different. Silver is not designed to shine during stability. It exists to react to instability. Every major financial rupture of the last century reveals the same pattern. Silver begins to move before the collapse becomes obvious. This isn't coincidence, it's structure. Silver sits at a rare intersection between two worlds, money and industry. That dual nature is what makes it such an early warning signal. In normal times, silver trades like a commodity. Its price reflects manufacturing demand, industrial cycles, and economic growth. But when stress enters the system, silver's monetary DNA reasserts itself. It stops behaving like copper and starts behaving like forgotten money. And when that switch happens, it usually happens fast. One reason silver performs early is market size. The silver market is tiny compared to global capital flows. Trillions of dollars move through stocks, bonds, and derivatives every day. By contrast, the entire investable silver market is small enough that a modest reallocation from institutional players can distort prices rapidly when hedge funds, family offices, or sovereign-linked capital begin shifting risk, even slightly. Silver feels it first. This makes silver hypersensitive to confidence shocks. When trust in currencies weakens, when debt sustainability is questioned, when central banks lose credibility, capital looks for exits. It doesn't always rush to gold immediately. Gold is larger, more liquid, and more controlled. Silver is more chaotic and therefore more revealing. Another factor is leverage. Paper silver markets are heavily leveraged. Futures, options, unallocated accounts, and synthetic instruments dominate price discovery. Physical silver, the real metal, is only a fraction of the paper claims tied to it. In stable conditions, the system functions barely. But in stress conditions, leverage becomes a liability. When fear rises, participants demand delivery. And when delivery is demanded, the illusion breaks. This is why silver often experiences sudden dislocations, sharp moves that appear irrational to outsiders but make perfect sense structurally. It's not speculation driving those moves. It's reality colliding with paper promises. Silver also reacts early because of its role in government response mechanisms. When economies slow or crack, governments don't respond with restraint. They respond with spending, massive spending. Infrastructure projects, green energy programs, military expansion, technological upgrades, all justified as stimulus or security. All of these require silver. Solar panels alone consume enormous quantities of it. Electric vehicles use far more silver than internal combustion engines. Advanced weapon systems and surveillance technologies rely on silver for conductivity and reliability. Medical technologies depend on it for its antimicrobial properties. This creates a paradox. During economic stress, industrial demand for silver often increases, not decreases. At the same time, mining supply struggles to respond. Silver is rarely mined on its own. It's mostly a byproduct of mining other metals like copper, lead, and zinc. That means silver production depends on the economics of entirely different markets. Even if silver prices rise, supply doesn't automatically increase. This rigidity matters. When demand spikes and supply cannot respond, price becomes the release valve. That's why silver tends to move early and aggressively. It has no shock absorbers. But there's a deeper reason silver performs before collapses. Silver is a psychological metal. It occupies a strange place in the collective memory. It's not officially money anymore, but it's never stopped being money in crises. People may not think about silver daily, but when confidence breaks, instinct kicks in. During currency crises, silver coins vanish from shelves. Premiums explode. Physical availability dries up even when paper prices claim stability. This disconnect has appeared again and again throughout history, from hyperinflationary episodes to banking freezes. Silver becomes the metal of last resort liquidity. Not because it's perfect, but because it's tangible, divisible, and trusted across cultures. Another reason silver moves first is that it is ignored until it isn't. Gold is monitored constantly. Central banks track it. Governments discuss it. Media covers it. Silver lives in the shadows. That makes it inefficient. Inefficiency is opportunity. When systems are stable, inefficiencies persist. When systems destabilize, inefficiencies explode. Silver's volatility is not a flaw, it's a signal. It tells you when something is wrong long before official data admits it. Rising silver prices often coincide with liquidity, stress, credit tightening, currency devaluation expectations, loss of faith in policy responses. By the time these issues show up in mainstream narratives, silver has already moved. And this is why billionaires don't wait for confirmation. They understand that by the time a collapse is acknowledged, positioning opportunities are gone. Silver does not reward late certainty. It rewards early doubt. In moments of calm, silver looks unnecessary. In moments of chaos, it looks inevitable. That's why it performs before the collapse, not after. In the next part, we'll address the question most people are afraid to ask. Why would billionaires willingly buy silver at $75, and why, to them, it still looks cheap? To the average investor, the number $75 triggers hesitation. It feels high. It feels late. It feels like the move has already happened. But billionaires do not think in numbers the way the public does. They don't anchor to price, they anchor to context, and in the current context, $75 silver is not expensive. It's early. This difference in perception is the key to understanding why elite capital behaves the way it does. Most people measure assets in dollars. Billionaires measure dollars in assets. That distinction changes everything. And when someone with deep capital looks at silver, they're not asking, is this cheap compared to last year? They're asking, what does this represent in a system that is structurally unstable? Because in unstable systems, price history becomes irrelevant. What matters instead is relative scarcity. Silver is scarce not just in geological terms, but in functional terms. It is one of the few materials that is simultaneously monetary, industrial, and strategic. It cannot be replaced easily, it cannot be printed, and it is disappearing into products that will never return to the market. Now place that scarcity next to the scale of global obligations. Global debt has surpassed anything ever recorded. Sovereign debt, corporate debt, consumer debt, derivatives layered on top of promises layered on top of confidence. None of this can be resolved through productivity alone. The math simply doesn't work. Billionaires know this. They also know how governments resolve impossible math problems. They dilute, not out of malice, but out of necessity. Currency dilution is the only politically survivable solution. Defaults are destabilizing. Austerity is unpopular. Inflation is quiet and gradual, at least at first. In that environment, assets that cannot be diluted become priceless, regardless of their quoted dollar price. That's why $75 doesn't scare smart money. Because the question is not whether silver can go from $75 to $90. The question is whether $75 today will still mean anything in real purchasing power terms tomorrow. Billionaires think in cycles measured in decades, not quarters. They understand that fiat currencies are temporary by design. Every fiat system in history has eventually failed or been reset. This one is no different, just larger. And when resets happen, pricing mechanisms break. Silver's role during resets is not subtle. Historically, silver doesn't rise smoothly during monetary breakdowns. It reprices violently. There are long periods of suppression followed by short periods of explosive adjustment. Those adjustments don't care about previous highs or psychological resistance levels. They care about availability. When trust collapses, demand shifts from paper to physical. When that happens, paper prices become irrelevant. What matters is what you can actually obtain, and at what premium. This is why billionaires are willing to accumulate even at elevated prices. They are buying position, not performance. They are securing optionality in a world where optionality is disappearing. There's also another layer to this strategy, one the public rarely considers. Silver is politically invisible. Gold attracts attention. It signals distrust in the system. Central banks monitor it closely. Governments regulate it aggressively during crises. Silver, by contrast, flies under the radar. It's too industrial to be dismissed, too monetary to be ignored, too boring to be politicized, until it's too late. This makes it ideal for quiet accumulation. When billionaires buy silver, they are not just hedging inflation. They are hedging policy risk. They are protecting against capital controls, currency freezes, and forced reallocations. Silver's smaller unit size also matters. It is divisible, transferable, liquid in informal markets. Historically, silver has functioned where banking systems failed, precisely because it could move without permission. This gives it a different kind of value, not financial value, functional value. At $75, silver still offers that function. And then there is the issue of relative valuation. Compared to equities trading at historically extreme multiples, compared to bonds offering negative real yields, compared to real estate priced on perpetually low interest rates, silver is not expensive, it is misaligned. Its price does not reflect its strategic importance. It does not reflect its consumption rate. It does not reflect the fragility of the system it exists within. That gap is what billionaires see. They understand that markets don't adjust continuously. They adjust episodically. Long periods of distortion followed by rapid correction. Silver lives in that distortion phase. And that's where smart money likes to buy. Because once correction begins, access disappears. Not gradually, suddenly. The final piece of the puzzle is time. Billionaires don't need silver to perform tomorrow. They need it to perform when everything else fails. They are not optimizing for upside. They are optimizing for survival. In that framework, $75 is not a top. It's a threshold. A price that reflects early recognition, not late panic. When panic arrives, the question will not be, is silver expensive? It will be, is silver available? In the final part, we'll confront the end game. What happens when trust finally breaks, and why silver's true role only becomes visible at that moment. Every financial system survives on one invisible ingredient. Trust, not gold, not oil, not even power. Trust. The belief that numbers on a screen represent real value. The belief that banks will open tomorrow. The belief that governments will honor their promises. The belief that debt can always be rolled over, printed away, or managed indefinitely. History shows that systems do not collapse when assets run out. They collapse when trust does. And when trust begins to fracture, it never does so politely. It cracks first at the edges, quietly, selectively, almost invisibly. Small anomalies appear, market signals stop behaving logically, liquidity thins, in places no one is watching. Assets that were once ignored begin to move in ways that cannot be explained by fundamentals alone. This is the phase we are entering now. Not a sudden collapse, but a recognition phase. Billionaires understand this stage well. They know the end game is not a single event, but a sequence. Denial, distortion, intervention, and finally, reset. And silver plays a role in every one of those phases. At first, silver moves quietly as confidence erodes beneath the surface. This is accumulation. Then it begins to outperform unexpectedly. Analysts scramble for explanations. Narratives are created after the fact. But by then, positioning has already happened. As the cycle progresses, governments intervene. They cut rates, they expand balance sheets, they launch emergency programs. They redefine what temporary means. Each intervention buys time and costs credibility. And credibility, once spent, cannot be printed back. This is where silver's real function emerges. Not as an investment, not as a trade, but as monetary insurance. When confidence in institutions weakens, silver steps into a vacuum. It becomes a bridge between systems, trusted not because of law, but because of history. This is why silver behaves differently in late cycle environments. It does not rise in response to good news. It rises in response to deterioration. When banks face stress, silver reacts. When currencies weaken, silver reacts. When debt sustainability is questioned, silver reacts. And when trust finally breaks, silver reprices. Not incrementally, decisively. In that moment, the conversation changes. It is no longer about charts or forecasts. It is about access, availability, settlement. Paper claims are questioned. Physical delivery becomes king. Premiums explode. Official prices lose relevance. This is the moment most people miss, because by the time it arrives, participation is no longer optional. History offers countless examples. In every major monetary reset, those who held tangible assets before the break preserved purchasing power. Those who waited for confirmation paid the price. Silver has always been part of that story, often overshadowed by gold, but no less effective, and in some cases more so, because silver is usable. It circulates when systems freeze. It bridges gaps when confidence collapses. It functions in places where institutions fail. This is the endgame billionaires are positioning for. Not apocalypse, not chaos, but transition. A shift from one monetary order to another. They are not betting on collapse for profit. They are preparing for it as a probability. That is the difference. While the public debates timing, smart money debates exposure. And silver offers something rare in late cycle environments, a way to step outside the system without announcing it. By the time silver becomes a mainstream conversation, the quiet phase is already over. At that point, accumulation turns into competition. Competition turns into shortages. Shortages turn into repricing. And repricing never asks for permission. This is why billionaires are quiet. They don't need validation. They don't need consensus. They don't need headlines. They understand that financial history does not repeat loudly. It repeats silently, then suddenly. Silver is not a prediction. It is a response to excess debt, to fragile systems, to confidence stretched too thin. And when the next chapter of monetary history is written, silver will not ask whether it is fashionable or controversial. It will simply perform the role it has played for thousands of years, preserving value when trust disappears. That is the endgame.